Warm welcome to today's week ahead video, guys. Now, we've got quite a lot to cover, so I'm going to get straight into it. Just as a quick update, you guys will notice that we've moved away from the live webinar and we've moved back to the video on demand or the week ahead video. Since 98% of you guys prefer to watch this as a recording, it just makes sense to do it this way as opposed to hosting it live. It means we can get the video out a little bit earlier to everybody, and it's just overall a lot more efficient doing it this way. So just a quick update on that. Now, we've got a very busy calendar coming up this week, lots of events to focus on. And it's a quick reminder, why do we even pay attention to all of these incoming events? Why we always focus on economic data? Why do we focus on central bank policy decisions? The reason why we do is because most of the time the markets are in what we call a Brownian motion, right? The markets needs catalysts to move, right? They need new events, they need fresh data, they need things like economic data points, they need things like central bank decisions to create that catalyst to really move. Now, sometimes it's not economic data, obviously. Sometimes it can be a geopolitical event that happens, wars breaking out, or all of the major drivers among financial markets. There can be much more than just economic data or central bank policy decisions, but those tend to be ones that we can plan for, right? We can't plan for major geopolitical events, but we can plan for economic data. We can plan for central bank policy decisions. So that's why we always pay attention to them. It basically gives us a reason to be in front of the charts, right? If we know that there's going to be important economic data and we know that those data points can trigger a lot of volatility, it makes sense for us to structure our focus around those events. It saves us in terms of time and screen time. We don't have to be watching the charts 24/7. We can basically just be around for when we expect those possible volatility triggers to occur. And obviously that is the economic data. Now, let's jump into things. We've got quite a lot to cover, but I think the first one we need to look at here is the events for the pound. Now, when it comes to the pound, and specifically the Bank of England, we've said this a couple of times now, and again, this is just my personal view, but I do think that the markets are not pricing in enough dovishness, if you will, for the Bank of England. Now, we obviously had the bank coming out more recently, shifting their focus a bit more dovish, downgrading their expectations for growth, downgrading their expectations for inflation, upgrading their expectations for the unemployment rate. I mean, expecting a higher unemployment rate, which is obviously worse. And yet the markets are still, to price the central bank aggressively in terms of cuts. We can see that one cut for the March meeting is now sitting at 65% probability. I think that should be more. Towards the end of the year, the markets are not even pricing in 2 full cuts for the bank. And I think looking at the recent data, looking at how markets are expecting the new budget from the Chancellor to impact growth in the medium term, I'm struggling to find out why or figure out why the markets aren't pricing in more cuts at this stage. So I do think the balance of risks is tilted towards a more dovish Bank of England, meaning towards more rate cuts this year as opposed to fewer rate cuts. And I think that means there is more pressure to be had on sterling as a result. Now, to be fair, we have had quite a lot of downside for sterling more recently, not as much as I would have expected to see. But if we look at the pound at the index level, we can see that sterling across the major currencies, it has rolled over recently and pushed lower. Now, coming into this week, we've got a whole batch of economic data we need to watch. All of them will be important. We start with the labor data coming out on Tuesday. Let me just quickly show you guys that. We've got the labor data coming up on Tuesday. We've got CPI data coming up on Wednesday. Now, these events, it obviously all triggers some volatility, but the main ones, the ones that we know the Bank of England will be keenly focused on, is the employment data coming up on Tuesday and then the CPI data coming up on Wednesday. Now, because I think the markets are not adequately priced for more cuts for the Bank of England, my preference for these economic data points would be to see downside surprises. That means for the unemployment rate to tick above that maximum expectation of 5.2, for things like earnings to price or print below the market's minimum expectation. When it comes to CPI, we'll be looking for misses below the market's minimum expectation as well. We basically want evidence that the markets are not pricing more cuts adequately, right? We want evidence that, okay, growth isn't looking good, the labor market isn't looking good, inflation is accelerating to the downside faster than what the bank anticipated, and that should provide some downside opportunities for sterling in the week ahead. Now, there's been a pair that we've been looking at since last week, and I didn't really find an entry that I liked on the pound kiwi, but it is still a pair that I am very interested in to trade. Let me just quickly open this up. Here we go. So last week we were looking at that key level around the 226, and we can see that the markets have now broken through that level, and we have now come back and retested that level that we were looking at, where we expected some sellers to lean back in and push the pair lower. However, the challenge that we have with trying to trade something like that right now is that we are kind of forced to have to wait for the data, right? Because we have key data. We've got the labor data, we've got inflation data, and apart from that, when it comes to the Kiwi dollar specifically, we'll touch on that a little bit later. We also have the RBNZ policy decision coming up. So the risk that we have with entering or leaning into this level right now, from a shorting point of view, is that we might be shorting this market just as the data comes out. And if the labor data is better and inflation does surprise to the upside, then we could see the pair pushing up even higher. So at this level, it's really a wait and see game for me personally. Again, this is my view on these pairs. It's my view of how I'm looking to approach this. It's not a solicitation for you to do the same. Think of this just as general factual information. Now, what I will be looking at is if we do see that labor and inflation data coming in softer, then that'll be a key level for me to look at for possible leaning against it, and we could expect some short sellers to step back in and push the pair lower. Key levels to watch for possible support is obviously the recent low from last week, Friday coming up, or Thursday coming up at 224.50. If we do manage to break below that, I mean, we looked at this last week as well, there's quite a lot of runway to the downside for this pair to open up. After that low, the recent strong support comes in all the way back down towards 223. So that's quite a distance to the downside, still something that I am looking at. Alternatively, if the UK data does come out slightly better than expected and we get the RBNZ decision, which we'll touch on in a second, coming in slightly less hawkish than what the markets are currently priced, then we could potentially see this push up all the way back up towards that 228, which can then, from a medium-term perspective, open up some attractive risk reward to the downside if, of course, we get a possible catalyst or a trigger that allows us to enter from those levels. So that is something definitely worth watching. I do still think pound kiwi is tilted to the downside from a pure central bank point of view. We've got a classic central bank policy divergence playing out between these two banks, with the RBNZ expected to hike rates, the Bank of England expected to cut rates. So that very obvious central bank policy divergence is something we are keenly focused on. And let me just show you guys what I mean by that. If we quickly open up the Bank of England and we open up the RBNZ, you can see that these two things are at a very different trajectory expectations, right? Bank of England expected to cut, RBNZ expected to hike, and that is going to be a key focus point. And we've got a couple of data points we need to watch, like I said. Now, the other pair that could be interesting to watch, now, this one is going to be a little bit more tricky because we just haven't seen a lot of love coming out for the US dollar. The dollar index is still struggling to break and stay above that 97 level. All the majority of last week, we tried multiple times, and even with solid NFP data, we just weren't able to break and stay above that level. Now, from a momentum point of view, that is looking very bearish. But if, the data in the UK does roll over and it does become a lot more ugly, if we potentially see a break and retest of that key trend support we've got sitting here for the pound dollar, that could potentially open up some interest for short selling. For markets to step in. So if we see something like this, potentially a rotation back down towards 130, 134 flat could be on the cards, maybe even lower back down towards 133.40. Again, the data will be critical for us to watch. It's not just UK data we've got coming up on Friday. We also have some US data, which we'll touch on in a second. But I think pound kiwi and pound dollar, definitely two that I am keeping a very close eye on with that UK data coming up this week. Now, the other one that I want us to keep an eye on is Canadian CPI data. Now, it's important to understand when it comes to CPI data for for the Bank of Canada right now, it's arguably not something that's going to shift them from a policy point of view anytime soon, right? The bank, obviously, we've got quite a lot of CPI data released at the same time. You've got your normal headline CPI, you've got your core CPI, but the one that the markets are really focused on is the BOC's preferred measure of core inflation. That is a combination between the CPI trim and the CPI median, and that is often the BOC's cleanest read of underlying inflation, right? That is their preferred gauge for setting policy. That is the one that they'll be focused on. And even though we had a nice dip to the downside in that preferred measure, it is still in the middle of the range, right? It's between that 2 and 3%. So there's nothing really for them to do right now when it comes to inflation. So I don't think whether we get a hot print or a weak print, I don't think that changes much for the outlook for the BOC specifically. Where I do think it gets a little bit more interesting, though, is if we consider what has been happening to the Canadian dollar from a positioning point of view. Here we can see that institutional investors, they've been trimming their short positions and adding to longs for quite some time now. And if you look at the forex breakdown, you can see that the Canadian dollar right now, surprisingly, with the growth outlook looking okay, the labor market looking okay, inflation pushing lower, there's nothing to get too excited about. But you can see the markets is sitting on a very bullish, crowded position when it comes to the Canadian dollar. I mean, look at how positioning has flared to the upside. So why is this important for us when it comes to CPI? If CPI should, for whatever reason, surprise again to the downside like we saw with the prior print, if we, for example, let's just go to the data. If we, for example, see that preferred measure of inflation dropping below the 2.5 measure, right, below that midpoint. If we start seeing 2.4, 2.3 for that preferred measure, that could be very interesting because that could start to see some of those very bullish bets on the Canadian dollar reverse, and that could provide some mean reversion to the downside for the Canadian dollar. Now, the reason why I like that from a dollar CAD perspective, if we quickly bring up dollar CAD here for a second, I'll quickly want to show you guys what we've got going on here for this pair. You can see that when it comes to these two, let me do this. We've obviously looked at the Canadian dollar, but take a look at the dollar aggregate. It's almost the exact opposite, right? As the markets have been piling into Canadian dollar shorts or Canadian dollar longs, they've actually been piling into US dollar shorts. So what does that mean? It means that if for whatever reason those Canadian longs were spooked out of their position, i.e. very, very low inflation data this week, that could provide some mean reversion opportunities for something like the dollar CAD. Now, if you consider just the economic situation between these two economies, right? The growth differential, meaning the growth comparison between them, the inflation comparison between them, the central bank comparison between them. There's just, in my opinion, very little reason for the markets to be short this pair right now. Now, just because something is stretched on the positioning side doesn't mean that you should be trading it. But what that positioning tells us is that the markets can easily be caught off guard in their positioning if we get a right catalyst, right? And that could be CPI. So I'll be watching CPI keenly. If we get a print of 2.4 or lower for that BOC preferred measure, I would personally be looking for some upside potential in the short term for the dollar CAD, maybe trading it back up towards that 137.40 resistance area on the chart. Nothing fancy, just looking for a little bit of a mean reversion play, a possible mean reversion play. The other one that you can obviously consider as well is things like kiwi CAD. That's one that we've been, bullish on for quite some time now, purely from, again, a central bank and a growth differential point of view. However, the risk that you have with entering kiwi CAD is that you'll have to, the risk you have there is you have to wait for the RBNZ, which is coming up the day after. So for that, in that sense, the dollar CAD just makes a little bit more sense. So talking about the RBNZ then, let's move on to that. The RBNZ is coming up on Wednesday. Now, in terms of policy expectations from the markets are expecting absolutely nothing from this bank. Nothing big is expected. However, and I think this is I've liked the Kiwi dollar higher for a while now. You guys know that. From a pure recovery play point of view, the markets have been pricing in more hikes. I do think there's a risk coming into this week, though, that maybe the markets have priced in a little bit too aggressive hikes when it comes to the RBNZ, given the recent data that we've had. If you can take a look, if you take a look here, by the end of the year, the markets are pricing in 40 basis points worth of tightening. That's almost 2 hikes already close to priced in by the markets. Now, if you take a look at the recent data, it's been looking pretty good, to be honest. But there is one big blemish right now. If you take a look at growth, it's been looking good. If you take a look at inflation, it's been too high for what the bank would like. However, this chart, the unemployment rate, the labor market, that is the big blemish that we have right now. I think if we didn't see the unemployment rate trend higher as we have over the last 2 or 3 prints, it would have been far easier for this bank to come out sounding a lot more hawkish. So I do think there's a risk, even though I still like this currency, I do think there's a greater risk that this bank doesn't sound as hawkish compared to what the markets have priced in for the bank already, right? If they come out, for example, and they give no indication that they are up for a possible hike, even later in the year, we can see that the first hike is only fully priced in by October. But if they were to come out and they say, listen, we need a lot more time, if their OCR projections that we'll get, which is their way of saying where they think interest rates will be going, if their projections show us that they actually see no chance of a hike this year, then the markets have some repricing to do, right? And that could be quite negative for the Kiwi. Now, obviously, I like the currency. So best case scenarios, they actually do come out and they do signal not just 1, but 2 potential hikes this year. I do think that with the trend in the unemployment rate, I think that is unlikely. And I think as a result, there is downside risks for the currency if the bank, they don't have to come out sounding dovish to see the currency push lower. That is what's important here, is if they come out and if they basically just say, listen, we're not sure whether we're going to hike this year, and they price no, or they signal no potential hikes, that won't be them being dovish. That'll just be them saying we don't know. But because the markets have already priced in close to 2 hikes, that could be a negative or see a negative reaction. Now, selfishly, I'm quite hoping that we do get a bank that doesn't sound as hawkish this week, because if that's the case, it could give us some really good opportunities to buy the Kiwi from better levels, right? If we were to see the bank coming out slightly less hawkish, that could be the trigger that pushes us up towards that 228, maybe even up towards the 230. That'll provide markets with opportunities to lean back against those levels and trade something lower that we do like lower in the medium term. So that is something that I am looking at. It is a potential risk for the Kiwi. If they do come out and they are a little bit less hawkish, then I would wait for a pullback in the Kiwi, in the pound Kiwi, to potentially trade that a little bit later. Alternatively, if they do come out and they are hawkish and they say that they expect even more than 2 hikes this year, I think that is the unlikeliest outcome that we can get. But if we do get that, then Kiwi versus the US dollar could be interesting things to look at as well. Momentum on this has broken to the bullish side quite aggressively. We've struggled to break above that key resistance around the 61 cents level. If we are able to break and close above that, it opens up a possible rotation towards that 62. Then traders will be eyeing the 63 above that. So there could be opportunities both ways, but selfishly, I am, I'm hoping that we get a bank that doesn't sound as hawkish, because that'll give us opportunities to just get into those pairs that we've liked for a while at slightly better levels. Now, the other thing that we will be looking at this week is the Aussie jobs data. Now, when it comes to the Aussie jobs data, I mean, the RBA itself, they surprised me massively with their prior decision. As most of you will know, I didn't think the bank had it in them to hike rates. Not only did they hike rates, they also gave us some pretty hawkish guidance as well, in terms of what they expect for rates going forward. So they think more hikes are needed to stabilize the economy. They think the economy is overheating, or has the potential for overheating. That means labor data will be very important as well as interesting for us this week, because if the data should come out this week showing us that the bank's fear of a overheating economy is overdone, meaning that there isn't any risk of an overheating economy and we actually have downside surprises coming out for labor, that'll put them in a very awkward position, and it will probably force the markets to reprice some of those very hawkish bets quite aggressively. We've got another hike fully priced in for the bank by the August decision, so that'll be interesting for us to see. Let's just call it June. We're very close to pricing a full one for June. If the data should come out surprising to the downside, the markets probably only expect one more hike by the end of the year. And if you consider how much we've seen the Aussie dollar rip recently, if you consider firstly the positioning data, which shows a massive long position. If you consider the Aussie dollar from an index level point of view, just showing you how aggressive this thing has trended recently. I do think that a lot of the hawkishness is already in the price. So the only opportunity that I would be looking for to basically see the markets being caught with their pants down, seeing them, positioned wrongly, is if we see very, very ugly labor data. What do I mean by ugly data? Look, I'm not expecting data to fall off a cliff here, but let's just look at a few numbers that I think could be interesting for the markets to pay attention to here. If we see employment, especially full-time employment, if we see any type of contraction, right, that'll put a blemish, a very ugly mark on that 65K we got back in December. If we were to see a contraction in full-time jobs, that'll mean that 1 month came in strong, 1 month bad, then strong, then bad. That is not a strong trend in terms of labor growth. The other one is the unemployment rate, right? If that was to tick up, let's say back up towards 4.4, that type of print is something that I think could get the market's attention, and that could provide some downside. Now, how can we look to trade that? The only pair that I will be looking at, and again, this is a risk for the RBNZ as well, but that Aussie Kiwi made such an interesting rejection last week. If you take a look at where we're trading on the daily, we traded into some crazy levels of resistance going back all the way to 2018. It's been on an absolute rampage. Now, yes, the retail market is still aggressively short the Kiwi, which isn't good news if you want to short it, because for the most part we want to be trading against them. If you take a look at the Aussie dollar aggregate, which is taking a look at all of the Aussie pairs and seeing how positioning is sitting, you can just see how aggressively short this market has been. The retail crowd, that is, and that is obviously a risk if you want to be shorted, especially the Aussie Kiwi. But if we were to see that labor data rolling over, and if the RBNZ comes out more neutral, for example, this week, as opposed to less hawkish, that could provide an opportunity to see a bit of mean reversion to the downside for the pair. And there's monster levels to aim for to the downside: 116.50. 116 flat, 115.50. I mean, we've got really strong levels of support, which wouldn't stop this bullish trend, but it would be some possible mean reversion areas to look for and to take advantage of. Now, the other ones we've got coming up this week that we need to pay attention to on Friday is we've got a whole fresh batch of flash PMI data coming up. Now, look, I'm not expecting a whole lot from this, to be honest. The best way that the markets normally trades around the flash PMI data. Let me just show you guys what I'm talking about here. Here we go. We've got the French flash PMIs, the German flash PMIs, the UK flash PMIs, and obviously the US flash PMIs. What the markets tend to do with this data is look for those very clear differential opportunities. What do I mean by that? You'll be looking for opportunities where you have one country's data coming in exceptionally bad and one country's data coming in exceptionally good. So, for example, if you see the European data coming in way below the market's minimum expectation, right? If the data comes in really bad and then the UK data comes in really good afterwards, then there could be some potential downside risks for the euro-sterling pair. Vice versa, if the Eurozone data comes in really good, above the maximum expectation, and the UK data comes in below the market's minimum expectation, so one good and one really bad, you could potentially look at some upside opportunities in euro sterling. So euro sterling tends to be a very good differential play depending on which way that data goes, but the data surprise has to be substantial, right? It has to be a really big differential to make that type of trade worth it. So euro sterling, definitely one worth keeping on the radar going into the end of the week. The other ones obviously coming up on Friday as well, which we'll be specifically watching for the US, is obviously the flash PMI data, but we also also have the core PCE data coming up. We've got GDP data coming up. So Friday's going to be a heavy one in terms of the US. And what's going to be challenging for the US is if we are in any trades. So, for example, let's say the UK data comes out really bad this week, and we find ourselves in any type of like a pound short, for example, pound dollar short. If we're in a cable short and the data comes in really bad for the US, then that's not going to be good for that trade, right? So we have to manage our expectations a little bit when it comes to that US data. If it does come out really, really bad, then if you are long the dollar, then that's going to be a risk. If you want to play it the safest, then obviously you can wait for all of the data to be erased, but normally by that time, a lot of the move potentially already played out, right? So there is a risk that you might be getting in at the worst possible time if that happens. So US data, obviously one to watch on Friday, but it's going to be one of those things that we'll need to weather the storm, basically, in terms of that data. If the UK data is bad enough, I still like pound dollar to the downside. We just need to know that going into Friday, there is some dollar risk that can obviously play against that type of trade. Now, in terms of equities, we have obviously seen quite a lot of volatility recently. It just seems like technology is struggling to gain any real type of momentum. We got right back up to that yearly pivot levels, which we've spoken about quite a few times. Always worth watching those yearly open levels for the major indexes. We can see the markets tried multiple times to break and close above it, and eventually we pushed lower on Friday into the close, and it's looking pretty ugly. The one possible risk factor we need to watch, we do obviously have a continuation of earnings. The markets will be watching any more negative comments coming out of how AI could potentially disrupt some of those additional industries. It hasn't only hurt software, as you guys know. It's moved into now transport. It's moved into consumer staples and discretionary as well. So there are some names that can obviously hurt in the week ahead with earnings. So that is one to watch for equities. Apart from that, we do also have earnings expirations coming up this week on Friday. So just keep that in mind. If you see some pretty weird price action, especially in VIX contracts or equity contracts towards the end of the week, it might have nothing to do with the fundamentals. It might have nothing to do with earnings. It could all be down to just some option expiry volatility that's hitting the wires and hitting the flows. So just keep that in mind as a possible risk as well. So with that said, guys, I've tried to keep this as short as possible today. So if there is any questions afterwards, please don't hesitate to let me know. And with that said, I hope everybody will have a fantastic week ahead. Let's hope we get some really good volatility out of those upcoming events.